A currency collapse, soaring borrowing rates, investors and businesses in despair. And that in just the span of a week. The roller coaster ride that the British economy has become may just be getting started if the government, regulators and central bankers can't work together to reassure markets and businesses. What will it take? What are the stakes of failure? And will the pound regain its luster? Welcome to our DW Business Special. I'm Stephen Beardsley in Berlin. And today I'm joined by Vicky Price. She's Chief Economic Advisor at the Center for Economic and Business Research. That's an independent economic forecasting firm in London. Vicky, welcome to our show. Before we get into the nuts and bolts of what happened this past week, I just want to ask you for your assessment. How strange was this past week, just looking at it from the perspective of an economist?
It was pretty strange. We had, in the space of just a few days, in fact, sometimes happening at the same time, a currency crisis with sterling falling very significantly to record lows against the dollar. We had bond prices falling very significantly and threatening a financial collapse, particularly for the pension industry in the UK. And we had yields going up to levels which we hadn't seen for a very long period of time, which we threatened really the entire interest rate structure of the UK. And all that in the space of just a few days, really, which, normally takes a little bit of time for that to happen. But this time it was very, very quick, and it required amazing amount of intervention from the Bank of England to calm things down.
We want to touch on all those aspects in just a moment. Let's go back or start at the beginning, I should say. And it did begin with the government's announcement last week of a new mini budget. It included cutting taxes and reversing several planned revenue-raising levies that were essentially holdovers from the last government. We're going to take a listen here to Prime Minister Liz Truss. She's talking at the beginning about an energy cap plan that's actually predates this mini budget. But then she starts talking at the end about some of the tax rebates that are part of this plan. Let's take a listen.
We were in a position where we were facing these ultra-high energy bills, increased inflation and a slowing economy. And the growth plan is all about supporting people on their energy costs, including businesses. Many businesses were forecast to go out of business, including pubs, if they hadn't had support this winter. But it's also about reducing the tax burden to make sure that we are not facing the same level of economic problems that we would have been.
All right, so Truss there mentioning her energy cap plan at the beginning of that. She mentions growth several times, and she talks about the tax burden at the end. I want to jump in there. These are, from what I've read, these are the biggest tax cuts in the UK since 1970. Vicky, what's wrong with this idea? If anything's wrong with lightening the tax loads on households and businesses during hard times, it sounds actually like it could make sense.
Well, nothing's wrong with that. As an idea, it does indeed make sense in the sense that you leave a little bit more money in people's pockets. And right now they need it, given that energy costs have gone up so significantly, and also for businesses which are suffering because of the increase in input costs. However, those tax cuts were unfunded in the sense that there wasn't any real indication of where the money was going to come from, except borrowing it in the capital markets. And what the problem with it was that it came on top of what Liz Truss, the Prime Minister, the new Prime Minister, was also saying in that clip you showed, which is the support on the energy price front. What had happened just a little while earlier, I mean, this government has only been in power a few weeks, was announced as soon as she became Prime Minister, but that was announced on the day that the Queen sadly died here in the UK. And then it was sort of buried, if you like. I shouldn't be using these words necessarily, but in all this that was going on. And then it resurfaced when people realized what the cost of that would be. So the cost is expected to be at least 60 to 70 billion this financial year, pounds, that is, in terms of extra borrowing in order to keep those prices at a particular level. And the expectation is that it's going to cost possibly a few more hundreds of billions of pounds over the next few years, unless, of course, gas prices suddenly collapse. So on top of that came this extra 45 billion, which, as you rightly say, was the largest tax-cutting budget since 1972, in fact, which really spooked the markets because they immediately worried that this will fuel inflation. It was unfunded. It would be very difficult to raise the money in the markets at any sensible interest rate. And the market practically went on strike, if you like, and led to very substantial increases in yields. In other words, Long-term interest rates went up very, very significantly, which in many ways would have negated quite a lot of the extra, sort of, if you like, largesse that the government puts back into the economy.
Vicky, one of the things that we hear from Truss and her ministers quite often is this idea of growth right now, that growth is a solution to get the economy out of inflation. Is that true? Can encouraging growth actually help the economy out of inflation?
Encouraging growth will not help the economy out of inflation. What you need to do is tackle the causes of inflation. I mean, what had been happening recently is because we have been growing, all the economies of the world have been recovering from the COVID period. We had this bounce back, a lot of demand happening, and that had pushed prices up already. So the growth had led to shortages of labor, increases in energy prices already, and commodity prices more generally. And that was in advance of the war in Ukraine, which of course led to a lot of these prices shooting up even higher. And right now it looks in a number of areas uncontrollably higher. So we've seen inflation rates treble or even increase 4 times in particular countries across Europe. And certainly inflation is right now way above target. So putting more money into the economy doesn't, through growth incentives, does not lead to lower inflation in the short term. What it can do in the longer term is if you become more productive because of lower taxation encourages you maybe to invest a little bit more if you're a business and to innovate more, then that perhaps can lead to productivity improving in the future. And that productivity increase leads generally to prices not growing anything like as fast. But you certainly cannot control inflation through tax cuts unless those tax cuts are specifically aimed at bringing some of the prices down. In other words, if you cut value-added tax, then of course you can bring inflation down. If you cut the energy price increase that was intended to be taking place, but now the government has stopped that, that is expected to reduce inflation by 4 percentage or 5 percentage points. Those are direct measures to assist that. The ones that were announced on Friday, September the 23rd, were not those types of measures, except of course for the energy price cap that was instituted, and it's happening from October the 1st for households and sometime in November for businesses.
Right. And as we've seen those measures having great consequences on the markets, for our viewers, you've probably seen the headline, "Pound takes a pounding," about 1 million times now. And that's because essentially it did. The pound briefly touching a historic low of $1.03 this past Monday. The first day of trading, that was the first day of trading after the policy announcement on Friday. Now, it slowly regained some of those losses this week, but in fits and starts, and really only after the Bank of England intervened with its bond buying announcement. Vicky has mentioned that as well. The pound is now tied with the yen as the worst performing currency this year, down about 20% against the US dollar as of this week. Also important to note here that the dollar has strengthened considerably over the same time. That's put a lot of pressure on these currencies. Forecasters had expected turbulence on the markets after this mini budget announcement. Vicky, did you expect something this dramatic with the pound?
We were very surprised about the size of the tax giveaway. So it wasn't very surprising that the markets reacted. And the concern was, of course, that inflation would be increasing as a result of that, and that maybe the Bank of England should be doing something quite urgently. And there were calls at the time that the Bank of England, which had met just the day before, had raised interest rates just by 50 basis points, whereas in the US and by the ECB, the increase that we had seen recently was 75 basis points, that maybe it had to meet immediately at an emergency meeting. It was not meant to meet again until November. That's the Monetary Policy Committee that sets the rates at the Bank of England. And raise rates immediately by 1%, perhaps by one whole percent. So in other words, instead of 2.25, we should be moving to 3.25 immediately, if not more, to calm the markets and make sure that sterling recovered. They didn't do that. They announced they weren't going to do it. They said they were going to meet again in November, but they were going to wait for a bit and see what happens anyway. But they will take everything into account and try and keep inflation under control. And then a couple of days later, of course, they intervened very significantly in the market in a different way by buying long-term bonds in the market, in the secondary market, the sort of quantitative easing they had done for a long period of time during COVID and before that with the Brexit crisis that we had, and before that with the financial crisis. And they bought 65 billion of long-dated bonds and brought the yields down, which had gone up to over 5%, and now they are at around 4%.
Now, Vicky, the government has blamed the strong dollar for the turmoil, and don't they have a point to some extent there?
Well, they do. I think the dollar has indeed been strong and against many currencies. And that's been an issue for not just for the UK, because, of course, interest rates in the US have gone up faster than has been the case elsewhere. So there is a gap which other countries are trying to make up for, if you like. So up to a point, it is the dollar, but to a considerable extent, it is also the UK. And the interesting thing is that the UK's growth expectations have been revised downwards by the markets. And one of the reasons for the weakness of sterling has to do with growth and not really necessarily to do with interest rates.
And it's not just currency traders who reacted swiftly to the government's plans, as Vicky mentioned earlier, but also bond traders, investors dumping government bonds, also known as gilts, in a very big way on Monday. Their bet, essentially, was that the government will have to borrow at much higher rates because their plans will drive up inflation. And that's led to some surprising comparisons in the bond market. Borrowing costs in the UK rising higher than those in Italy and Greece, at least when you look at the 5-year gilt in recent days. Both of those governments with much higher debt loads and traditionally much more difficult borrowing conditions than the UK. Now, Vicky, you've touched on this already a little bit, but what is this turmoil in the bond market essentially telling us?
It's telling us that the markets are worried about the amount of borrowing that the UK is going to have to do, because, of course, just supporting the energy price for consumers and also for businesses is going to cost hundreds of billions, unless, of course, the gas price comes down quite significantly. But also, of course, this extra money that they're putting into the economy is going to have to be borrowed. So they intend not to raise taxes to pay for this redistribution, if you like, in terms of cutting income tax, which is what they want to do. And also taking away some of the tax increases for businesses. You would expect that they would perhaps want to tax those at the higher end of the pay scale, or perhaps the energy companies a bit more. They're not doing that, quite the contrary. So that's a bit of a worry. So the markets have said we're going to have a bit of indigestion here. We're not going to be able to sort of buy all those bonds you're selling. And there is an extra dimension, I'm afraid, which is the Bank of England itself. Because when they raised interest rates last Thursday by 50 basis points, they also announced that they were going to start quantitative tightening. In other words, starting to sell a lot of those bonds they had accumulated during COVID and during the previous periods when they intervened. And that would be about 80 billion bonds a year is what they're intended to do. Well, they had to abandon that because the markets added it all together. There's 80 billion from them, the Bank of England, and then hundreds of billions, if you like, from the Treasury itself directly, because they needed to borrow more to help growth, if you like, and help ensure that businesses and individuals and households carried on surviving. And they said, no, we're actually very worried about what this means for debt, what it means for the amount of debt that you will be issuing. And they wanted much, much higher interest rates as a result. So the Bank of England said, OK, we're not going to start selling gilts. What we'll do instead is we're going to go back to doing quantitative easing, which they had said they weren't going to do anymore. They had stopped doing it quite a few months ago. So there's been a reversal of that policy. The interesting thing is it's the first country that has reversed that policy. The US has stopped QE and is about to enter, probably is doing already, in fact, right. QT. The European Central Bank says it will start QT when things normalize a little bit, but it stopped doing QE as well, quantitative easing. So the UK is really out on a limb again on that, but it had to do it. Otherwise, the yields were so high that they were threatening to bring pension funds into illiquid positions.
So some extraordinary measures we've seen from the Bank of England, reversing positions that much earlier or much at a different time rate than it had expected. Help us understand what this means, these borrowing rates, that is. What does it mean for normal borrowers? This has an effect on mortgages, for example, correct?
Oh, absolutely. I mean, long-term rates are set by what happens in the bond market. Of course, short-term rates matter as well, because lots of people are borrowing on variable interest rates as well, so which change depending on what happens at the Bank of England setting of interest rates. But the longer-term rates matter hugely for individuals and mortgages. They also matter hugely for businesses. And if they go up, then that's a big, big problem in terms of the ability of anyone to pay what they owe on the mortgage, or if they are coming back to set their mortgage rates, because obviously a number of them are already fixed 2 years, 5 years, and they're coming up for renewal, then they have to do it at higher interest rates. And that, of course, means out of their monthly income, which is not going up in line with inflation, they're going to have to be paying sometimes 3 or 4 times more than they were paying before. That is ruinous, actually, for many. But there was a bigger issue, which was that pension funds that invest basically in long-term gilts, mainly 30-year gilts, just so they can pay the pensions and have enough money to pay the pensions when they're coming due for people, long-term pensions, were finding that those bond prices were falling very significantly. So whatever they had as collateral, whatever they had, if you like, in the bank, or whatever they had in their accounts was collapsing in price. So they were being threatened with becoming insolvent, and that would have been disastrous. So the bank had to react and intervene because it looked like a financial crisis was on the making.
And that's when we saw that intervention, as you talked about it already a little bit. We talked also to David Blanchflower earlier in the week. He's a former member of the Bank of England's Monetary Policy Committee, and here's how he explained the bank's intervention. Take a listen.
They're going to run auctions every day, and they're going to try and keep a track of that. And they've talked about perhaps doing something by the end of November. And the Bank of England talked about, oh, we'll do something at our next meeting early in November. Well, I wouldn't believe a word of that. We're in crises such that markets are moving by the hour. There's going to be more interventions necessary. The question is, where are we going from here? I suspect we're going to have to see major action. And I think what's very telling is the IMF produced a statement yesterday saying this has got to be turned around. This is an inappropriate set of measures. This will raise inequality. So the very fact that the IMF comes out and says that, can you imagine over the last 30 years the IMF would come out and say something about economic policy in France, in Germany, but in the UK? So this is really, and it's called for basically withdrawal of these measures. And we've no real clue where it's gone. But this is not going away quickly. It's not going to be solved by waiting till the end of November.
All right, that was David Blanchflower. He's a former member of the Bank of England's Monetary Policy Committee. Vicky, where are we headed? What does the government need to do, as well as the Bank of England, to turn things around?
The first thing it needs to do is produce some sensible figures for what the policy implications and fiscal implications of what they have announced will be. And are we seeing any sustainable sort of debt situation in the future, or are things going to get considerably worse? And that's one of the things which is worrying the market. They want to see some evidence, if you like, or some proper analysis. This mini budget was prepared and presented without any of that being made public in any way. So we are going to get a little bit more of that. But I think also there is a possibility that some changes will take place. It's interesting when we talk about this big injection of money and tax cuts that some of them are not taking effect until next year. So there's plenty of time to change your mind. And of course, politically, it's really caused an awful lot of dissent, even among the Conservative Party members and also MPs. So let's see what happens there. But the other thing is that the Bank of England would probably have to intervene again. They say that they're doing these auctions, if you like, over the next fortnight, and they're going to stop doing that on October the 14th, and then they're going to go back to their earlier policy of quantitative tightening. I just can't see that happening. I'm suspecting that will be abandoned for the time being until things normalise.
Vicky, a bit of a political question to sort of wrap things up and bring it together. What has this fiasco of the past week, what has it meant for the nation's confidence in this government to handle its finances?
The nation has been suffering from this huge cost of living crisis, wages not rising in line with inflation. Again, perhaps we're not unique in this, but it's been pretty bad in terms of living standards, and businesses crying out for support, and they felt they didn't have it really. And then this happens, which is increasing uncertainty even more. So that's not good news. And it also is seriously surprising that the government could put the economy, if you like, at such peril. But just doing a few things which they should have done a little bit better, and the way in which they announced what they intended to do and the way in which they intended to implement them has meant that confidence in them has deteriorated very significantly, and we have seen that in the opinion polls as well. One hopes that this has been a lesson, and that they will somehow or other manage to pick up the pieces. And they're trying quite hard with lots of optics, talking now to the independent forecasters and making sure that whatever they do next is properly backed. But I think there will need to be a lot of reassurance between now and November that they're in control.
All right, and that's a nice point to wrap up our conversation for today. Looking at this past week in the UK, we're going to leave it here for this week's business special. I want to thank Vicky Price with the Centre for Economic and Business Research in London for joining us. And thanks to you for watching. While you're here on YouTube, why not check out some of our other videos, including our other business specials and our Business Beyond series. Until next time, do take care.